June 2008. In the middle of a looming economic recession, historic events were transpiring in what is arguably the single most important market on Earth, crude oil. That month, the price of a barrel reached an inflation-adjusted $157, a price that many argue broke the camel's back, sending the world into what will later be known as the Great Recession. From there, oil collapsed, and slowly the commodity retreated into irrelevance. Oil stocks became boomer plays, and the once dominant sector fell to all-time lows. In April of 2020, we witnessed oil get so beat down the WTI May contract went negative, an absurd event that showcased just how far the commodity had fallen. Oil was declared dead, but outside the media echo chamber, the reality was much different. Oil was poised for the comeback of the century, and we are now entering its most critical phase before the superbubble erupts. In today's video, we break down the single most important story in finance, the scary future of oil, and its implications on the economy. Something shocking to think about: the world's largest oil producer isn't Saudi Arabia, Iran, Venezuela, or Kuwait. It's actually the United States of America, and while many fail to accept it, oil is arguably the single most important commodity in the world. Sure, there has been an increase in alternative sources, but we are not even close to replacing the black gold that is crude. Energy is life, and the lack of energy is death. Apply this philosophy to world geopolitics, and you see a clear pattern emerge. A pattern that explains most of the wars, conflicts, and movements we have seen in the past 40 years. The fight for oil is the fight for life on the world stage, and if you think foreign powers are not attempting to influence US energy production, you are absolutely wrong. There's a very good reason why suddenly there has been a massive movement to limit energy investments here in the US by labeling them as destructive. But dig deeper and you find that many of these groups have an alternative motive. Earth Justice, for example, pushes for the US to power everything with 100% clean energy, but search the pages for nuclear and you'll find exactly zero results. In fact, led by certain powerful activists with questionable motives, many oil companies were convinced, or maybe a better word would be forced to, limit energy investments. This shift in policy has led to a massive hole. For example, if we looked at drilled wells here in the US, the data suggests that US oil production may grow less than expected as the industry depletes its inventory buffer and loses the flexibility to increase production to respond to rising demand. Now, with oil demand already surpassing pre-2020 numbers, you start seeing the problem emerge. The stage is set for an epic run in energy prices, one that could easily see the barrel reaching $200. And this isn't my opinion, this is the opinion of many prominent commodity researchers, people like Doug King. Add in the risk of serious geopolitical conflict, maybe a war or an invasion by the world's third largest oil producer, and you see the potential of an oil price disaster. Jeff Currie, Goldman Sachs head of commodity research, joined CNBC's Squawk Box to explain just how serious this rising issue is. Take a listen.
Joining us right now with his outlook on where prices are headed is Jeff Currie. He's global head of commodity research at Goldman Sachs. Hey, Jeff, early this morning, Richard Engel was on from NBC talking about just the heightened tensions right now between Russia, the United States, the Ukraine, and everything that's happening with NATO. This is a serious point of inflection. This is something that really matters right now. And maybe we don't talk about it enough, but it certainly looks like it's getting picked up on when it comes to the global markets, especially in the price of oil.
Well, when we look at the movement in the last couple of days, I want to emphasize that it's driven by fundamentals, not the geopolitical risks. Now, the market is much more vulnerable today to these geopolitical risks than ever before, at least in this cycle, because inventories are so low. So the very tight fundamentals makes the market more exposed to these events. But at this point right now, these geopolitical events really haven't led to any substantial disruptions in supplies of oil around the world. And I think it's important to emphasize that a lot of the risks that created that big pullback on Black Friday back in November of last year have all turned out not to have an impact on demand, whether it was Omicron, the SPR, or even OPEC. Bottom line, fundamentals continue to decline. Demand remains strong. The IEA flip-flopped on their weak demand forecast and put out a much more bullish outlook on demand right now, which underscores just how tight this market is. So I want to point out this market is fundamentally tight. Demand is above supply still. We don't have adequate supplies to cover this demand growth. That's what creates this upside risk. Our target by the second half of this year is over 100 at 105.
So there you have the Goldman head of commodity research essentially saying that the price of oil is just waiting for a catalyst. A spark would ignite the commodity to levels we have never seen before. The gap between repressed supply and demand could push to unimaginable levels if conflict were to erupt. And even without the conflict, there are multiple variables that many are ignoring. We know from research that once a society enters the developed world, oil consumption skyrockets. And if you've been paying attention to international markets, you would know that the majority of these people are poised to enter this group in the near future. When they do, the already stretched supply is going to reach critical levels. And guess what? If you're looking at OPEC and Russia to feed this increased hunger, think again. Take a listen to Jeff explain even further.
In terms of fixing the supply picture, could OPEC and Russia fix it somewhat if they wanted to, or do they like prices where they are?
You look at the world right now, there are only two producers who can produce more today than what they could in January of 2020 before COVID struck. And the answer to that is UAE and Saudi Arabia. Russia struggles to even hit their OPEC plus quotas right now, which underscores the lack of investment to grow supplies. The U.S. is nearly 1.8 million barrels per day below those January 2020 levels. So what it indicates is that OPEC, Russia, outside of a select few producers, do not have the capacity to be able to meet these higher demand levels, which is why inventories are likely to draw to critical operating levels during first quarter and create a lot of upside price risk. That's why our price targets, our forecasts are now well above 100 or at 105, which underscores the risk here.
So in summary, we have the following. A massive underinvestment problem here in the United States will create supply issues in the near future. Then we have the increased geopolitical risks around the world, mainly with Russia and Ukraine, but also with the Middle East. You may not know that the UAE was attacked by drones earlier this month. On top of all this, we have a massive demand wave coming if indeed the spring brings us a long-awaited opening of the world and with the emergence of new countries into what we consider the developed circle. The stage is set, massive amounts of demand, and a potentially limited supply. All of this within a commodity that you simply can't replace, at least not for now. What you end up with is a potential disaster. Record-breaking prices around the world in history's largest oil shock. But before I end the video, I just wanted to make a few things clear. First, I'd like to shout out DoomBerg. It's a Substack that I have no affiliation with, but many of the stats I used in this video were taken from their recent article labeled Shooting Oil in a Barrel. I have linked it in the description so you can check it out for yourself. And second, I want to be transparent and acknowledge that I have a 5-figure position in USO call leaps, a play that would make me significant returns given a move up in oil prices. Obviously, I'm not a financial advisor and I do not recommend following any of my positions. Oil is an elastic commodity that can see massive price shifts overnight, and a price collapse can happen quickly. If you guys enjoyed the content, please don't forget to hit that like and subscribe button, and if you have a moment, follow me on Twitter. That link is also in the description.